One of the stocks in my portfolio that has been off to a pretty hot 2026 is Texas Instruments. So far, I'm currently up around 45% on this position. And if we look at it so far just in 2026 alone, it's up nearly 20%. But if we zoom out and look at the last 3 years, the picture isn't nearly as pretty. In fact, the share price has been very choppy, and the stock is only up by about 24.21%. And if we look at the last 5 years, the stock is now only up by about 19.36%. And what's perhaps even more concerning is look at what's happened to net income during that time. Net income in 2021 around $7.7 billion, in 2023 around $8.75 billion, but it's fallen off a cliff. But despite this, the share price has continued to climb higher. Is this a red flag? Well, that's just one of the many reasons that Texas Instruments stock is quite interesting right now. One of the other reasons that makes Texas Instruments quite interesting is over on Dividendology.com, I recently released an article on the most frequently bought dividend stocks by super investors in Q4 of 2025. And one of the things you'll notice is on this list, we can see Texas Instruments came in at number 7. Super investors are buying Texas Instruments. So in this video, we're going to be taking a deep dive into Texas Instruments, seeing why super investors are buying this stock. Why is the share price climbing while net income continues to fall? And is Texas Instruments interesting at these prices? To analyze these stocks, we're going to be using forecaster.biz, which you can check out at the link in the description. Again, it's a great tool, and one of my favorite things to do is to simply overlay the company's fundamentals with the share price, because as we know, over the long term, fundamentals is what drives share price higher. So let's go ahead and dive in. Now, let's get just a little bit of background on Texas Instruments stock, because while the last 5 years isn't too pretty, if you zoom out and look at the last 10 years, they're actually up by around 300%. So this is a stock that has actually way outperformed the market. And during that time, we can see sales has gone from sitting at about $13.37 billion to about $17 billion. So yes, it's grown, but growth has really not been that substantial. The same is true if we look at net income. We can see overall it's grown, but it's seen a drastic pullback in the last few years. But despite this, the share price, yes, it's been choppy recently, but it's continued to climb higher. On top of this, historically speaking, this has been an absolutely phenomenal dividend growth stock. Like clockwork, they continue to grow dividends at a very high rate. So who is Texas Instruments? What exactly do they do? Well, they serve a wide variety of customers, but they typically operate in two main business segments. Number one, we have analog, chips that convert real-world signals like sound, temperature, or pressure into digital data. This is their largest and most profitable segment, representing roughly 3/4 of their revenue. So this is the bulk of the business. And then we have embedded processing, microcontrollers and processors that provide intelligence and control for systems in industries such as automotive and industrial applications. So more than anything, this is a semiconductor stock. Most people know it because of their calculators or other consumer electronic products, but more than anything, yes, it is a semiconductor stock. Now, semiconductors are obviously a hot industry right now. And Texas Instruments is a company, again, that super investors have clearly taken note of in the recent quarter, with it being the 7th most frequently bought stock. But why would a stock like Texas Instruments be bought by super investors when the share price has climbed higher, but simultaneously net income is going lower? What does that mean if the share price is going higher while earnings are going lower? Well, it means the valuation multiple is going higher. It's going considerably higher. For the first part of the last 5 years, we can see that PE multiple was sitting in around the 20 to 25 range. It even dipped below 20 in some instances. Well, right now, with this recent increase we've seen to start the year, the PE multiple, according to Forecaster, on a trailing 12-month basis, is 38.77. That is a high PE multiple. This is what we need to figure out. Now, Texas Instruments very recently, just a few days ago, released a capital management presentation for 2026, and this gives us some critical information that we have to understand. So let's go ahead and look at their executive summary. What do they say? At Texas Instruments, we run the company with the mindset of being a long-term owner. We believe that growth of free cash flow per share is the primary driver of long-term value. This is what I've been talking about on the channel all the time for the last few years. Free cash flow per share is the ultimate driver of intrinsic value. And they say that after accretive investments in the business to grow free cash flow for the long term, the remaining cash will be returned over time via dividends and share repurchases. And historically speaking, that is what they've done. So their focus is on growing free cash flow per share. So what has free cash flow growth over the last few years looked like? Well, if we go to financial statements, pull up the statement of cash flows, Look at free cash flow. Look at free cash flow versus the share price. From 2006 to 2022, it looks like the charts make sense. The share price is following the growth of free cash flow. But then free cash flow absolutely falls off a cliff, but the share price doesn't drop along with it. Does this mean we are due an impending massive drop in the share price? Because at first glance, this looks like a major red flag. Well, we need a little more context. As you probably know, most of the big tech stocks are expecting very little free cash flow growth over the next year or two. Why is that? Well, it's because they've heavily increased their capital expenditures, their Capex spending. Increased Capex spending lowers free cash flow. This has been the major news story for the last year or two. Well, believe it or not, Texas Instruments is the OG when it comes to ramping up Capex. This is something they were early to the party on. And this is the chart that really paints the picture. Remember, free cash flow is simply operating cash flow minus capital expenditures. When we look at this charted out over the last couple of decades, we can see operating cash flow was growing while we saw minimal increase in capital expenditures. That's beautiful because it enables free cash flow to grow at a high rate, not just because operating cash flow is growing, but because the margins are expanding. But all of a sudden, after 2022, we saw a rapid increase in capital expenditures. The Capex to revenue ratio for the majority of the past few years was really sitting in that 5% range, when in 2025, it was about 26%, so about 5 times higher than it historically had been. Why has this happened? Well, Texas Instruments is nearing the back end of a 6-year period of elevated Capex spending. So if you look at the expected Capex spending for 2026, it's been reduced dramatically compared to 2021 through 2025. Now, the reason this has happened is actually relatively straightforward. Texas Instruments has been building out their 300mm semiconductor wafer capacity, and the implications of this over the long term are immense. And they show a great example here. They contrast a 200mm semiconductor wafer versus the new 300mm. What is the difference? Well, if we look at the sales price of the example part for the 200, we can see maybe the chip cost is around 20 cents, assembly, test, and other around 20 cents, so total cost of 40 cents. Meaning gross margins of around 60%. Well, with the 300mm, we can see the costs are substantially lower. Total cost would be about 32 cents relative to the $1 part, meaning gross margins are about 68%. They're going from 60% margins to around 68%. Obviously, the implications of this are massive. Think about what Texas Instruments now has the ability to do. Not only have their margins been expanded, but they can now decide to pull back on their Capex spending. They are really about to turn the free cash flow generation machine back on. And in fact, when we look at free cash flow per share before the period of elevated Capex spending, it started trending closer to about $6 to $7 per share before it dropped down heavily. But what they're telling us now is during 2026, they're on track to deliver more than $8 of free cash flow per share at their current revenue consensus. Now, this is a key number. We'll have to take this into consideration a little bit later in the video, but don't forget that $8 of free cash flow per share. Now, of course, as it relates to the dividend when it comes to Texas Instruments, we can see that starting yield sitting at about 2.62% with a beautiful history of double-digit dividend growth. But what's concerned a lot of people is if we jump back over to the financial statements and look at the statement of cash flows, look at how much they've been paying out in dividends. Now, at first glance, of course, this looks concerning. In 2024, they paid out about $4.8 billion in dividends. Now, remember, how much did they generate in free cash flow in 2024? Well, we can see 2024 free cash flow was only about $1.5 billion. Remember, dividends are paid out of free cash flow. So their free cash flow payout ratio was well over 100%. That's typically a major red flag. But really, this was all a part of the capital allocation plan for Texas Instruments to massively expand their margins in the future. And so there's no doubt this period of elevated Capex spending over the last few years has caused a lot of uncertainty for a lot of investors. There's no doubt it's a large reason that over the last 5 years, the stock has only climbed by about 20%, and essentially all those gains have come in 2026. The stock before 2026 was pretty much flat over the last 5 years. And the share price has been incredibly choppy. Look at this. To start, near the back end of 2024, it's about $220 a share. It dropped all the way down to under $150, climbed back up to $220, climbed back down to about $150, and is again now back up to around $220 a share. So we now understand the background of the capital allocation for Texas Instruments, what's been going on. And we understand that this period of elevated spending on capital expenditures is coming close to an end now. And as a result, free cash flow per share will surge. But that doesn't answer the question of when the stock is a good opportunity. Here's what's so interesting right now. Over on Dividendology.com, I have a database. I have multiple databases, but one of the things that I track is the Super Investor database. I update this for members every single quarter. And while there's obviously a lot of value in simply seeing what stocks super investors bought in the recent quarter, there's a lot more value in seeing what are the underlying trends over different time periods. And Texas Instruments is a perfect example of this. If we look over the last year, Texas Instruments in the recent quarter, Q4 2025, was the 7th most frequently bought stock. In Q2 of 2025, the 12th most frequently bought stock. And in Q1 of 2025, the 6th most frequently bought stock. But it wasn't anywhere to be found in the top 50 on the list in Q3. Now, obviously, this information is interesting by itself, but it gets a lot more interesting when you keep that information in mind while simultaneously looking at the share price movement of Texas Instruments during these different time periods. The only quarter where the smart money was not buying was when Texas Instruments was trading at its highest prices. But the smart money was buying when Texas Instruments was trading in that $150, $170 per share range in multiple instances. Fortunately for me, that's the price range that I was also adding Texas Instruments. So we can see the smart money was quite literally buying the dip in multiple different instances. So how attractive is this stock at current prices? Well, we have to remember the valuation multiples really kind of lie to us in this instance because the earnings, the free cash flow of this stock are somewhat compressed due to the elevated Capex spending. So instead, let's use a discounted cash flow analysis model. Now, typically when we run a DCF model, all we do is look at the historical free cash flow and then essentially apply a growth rate to the future free cash flows. But if I did that in the case of Texas Instruments, maybe they grow free cash flow at a rate of about 12.5%, and keep in mind the EPS CAGR projection from 2026 to 2030 is about 16.37%, so it's actually quite high. So again, free cash flow growth projection of 12.5%, well, we could still see the stock is only worth about $80.09. But if you've been paying attention, you should know this. This is not the right way to run a DCF model for Texas Instruments right now. Again, why? Well, it's because look at free cash flow in 2023 through 2025. It was compressed due to capital expenditures. So the real question we have to ask is, what is free cash flow going to look like in 2026? Well, remember how I told you to keep in mind that one number, $8 of free cash flow per share? That's the key metric. If they hit $8 of free cash flow per share during 2026, then that means overall free cash flow will be sitting at a range of about $7.2 billion. So let's manually plug that into our 2026 free cash flow. All of a sudden, if we apply our 12.5% growth rate based off that 2026 free cash flow number, we can see the fair value of the stock comes in at about $216.44, which is extremely close to the current share price. It's only about 2% higher. So what do we see? Well, it looks like Texas Instruments is pretty close to fair value at current prices. Now, I get comments from people all the time, well, you should have covered this stock when it wasn't sitting so close to its fair value. Well, I have a couple of quick thoughts. To start, this is a stock I've been covering for years. In fact, once a month on my newsletter, I send out a list of undervalued dividend stocks, and one of the stocks that I listed in my October newsletter when they were trading at a much lower price was Texas Instruments. So in the case of Texas Instruments, yes, it was frequently covered when it was at these lower prices. But perhaps the more important takeaway is what you have to understand is, in the short term, share prices can be extremely volatile. You should still be researching stocks when they're trading at levels that may appear overvalued, because they won't stay overvalued. You'll inevitably see pullbacks on the stocks in your watch list, and if you're keeping up with them closely, running valuations, digging deeper into the business, you'll realize when those opportunities start to present themselves. Ironically enough, that's quite literally what the smart money has been doing over the last year. So what do I think of Texas Instrument at these prices? Well, I think it's fairly close to fair value right now. With that being said, I'm quite happy to continue to hold it in my portfolio. Sentiment around this stock is finally starting to change because there's light at the end of the tunnel. We can see the path to growing free cash flow once again. And as a result, people can see the path to higher levels of dividend growth in the future. So if you simply look at this chart and look at share price versus net income, you're going to be scared away. If you dive deeper into the business, understand the capital allocation plan behind what they've been doing, all of a sudden it looks much more attractive. So go ahead and let me know what you think of Texas Instruments in the comments down below. And again, be sure to check out forecaster.biz at the link in the description. It's the tool we were using throughout this video. You can get 10% off at the link. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.